Home prices just hit all-time highs, while unemployment is rising and consumer spending is collapsing, and nobody's talking about how broken this actually is. I'm breaking down the housing market divergence that's about to reshape everything you thought you knew about real estate, inflation, and where the economy is actually heading. Welcome back to Market Pulse Report. Let's start with the jarring disconnect. According to the most recent S&P Case-Shiller data, the National Home Price Index sits at 176.24, essentially at all-time highs. That's the good news if you're a seller, but here's where it gets weird. The Conference Board leading economic index is down 0.3% from last year. The unemployment rate ticked up to 4.3% in recent months. Initial jobless claims are hovering around 230,000-260,000 per week, well above the 200,000 threshold that typically signals labor market stress. Consumer spending, which drives 70% of GDP, is showing cracks. Credit card delinquencies are rising. Real wages adjusted for inflation are basically flat. And yet, housing prices remain elevated. This is the housing market divergence, and it's the most dangerous mispricing in the economy right now. Pattern interrupt, so let's break down why this is happening. There are actually four major reasons, and they're all interconnected. First, the Fed's messaging created a soft landing narrative that refuses to die. After the banking crisis in March 2023, the Fed pivoted hard on rate hike expectations. Even though inflation remained sticky, the market priced in rate cuts aggressively. We got our first cut in September 2024, and the market is now expecting 6 to 7 cuts through 2025. When investors believe rates are coming down, they extrapolate that into higher present values for future housing cash flows. A $400,000 home that generates rental income looks more valuable at 3.5% rates than at 5.5% rates. So before rates even fell, the market started pricing in that future reality. Housing is uniquely vulnerable to this kind of forward-looking pricing because it's the most illiquid and leveraged asset most people own. Second, limited supply. We're still running a massive housing shortage in this country. The National Association of Home Builders estimates we're short approximately 4.5 million homes. That shortage was built up over more than a decade of underbuilding after 2008. Now here's the problem. Construction costs are spiking because of tariffs and material inflation. The incoming tariff regime, 25% on Canadian and Mexican goods, which supply 35% of U.S. building materials, is about to make new construction even more expensive. When new supply becomes more expensive to build, existing homes become relatively more valuable. It's basic supply and demand. A shortage plus higher replacement costs equals sustained pricing power for existing inventory. Third, demographic flows. The U.S. is still adding population through immigration and household formation. We're creating roughly 1.3 million new households annually, but only building about 1 million homes. That gap is being filled by investors, corporate landlords, and price appreciation on existing homes. This isn't a natural market. It's a consequence of policy-driven constraints on supply. Fourth, investor demand replacement. After the commercial real estate downturn, institutional money that would have gone into office buildings is now flooding residential real estate. Blackstone, Invitation Homes, American Homes for Rent. These mega investors have been quietly accumulating single-family homes for years. In some markets, institutional buyers now account for 30–40% of transactions. This creates an artificial floor under prices because these aren't marginal buyers. They're capital-backed institutions with 20–30-year holding periods. They're not selling when prices dip 5%. They're buying more. Pattern interrupt, but here's where the divergence becomes dangerous. None of these factors are sustainable in the face of economic deterioration. Let's talk about the real economic data underneath the housing boom narrative. Consumer credit is stretched. Americans have $1.16 trillion in credit card debt, a record high. Credit card delinquencies are at 2.44%, up from 2.09% 2 years ago. Mortgage delinquencies are rising, though still historically low at around 0.8%. But the trend matters. Mortgage forbearance programs have ended. We're no longer artificially supporting household balance sheets with stimulus payments. Student loan repayment restarted in October 2023 after a 3-year pause. That's removing $200 plus per month from millions of households' budgets. Meanwhile, wage growth is decelerating. Real wage growth, that's wages adjusted for inflation, is basically flat. Nominal wages are up 3.9% year over year, but inflation is at 4.8% depending on the measure. So real purchasing power is growing at maybe 1.5% annually. That's not enough to justify the valuations we're seeing in housing markets, where home prices have doubled in 5 to 7 years. Let's look at specific markets where this divergence is most extreme. In Austin, Texas, median home prices hit $515,000 as of late 2024, up from $285,000 in 2019. That's an 81% appreciation in 5 years. Meanwhile, Austin's unemployment rate ticked up to 4.1%, and tech layoffs have been constant. We're talking about 30,000 plus jobs lost in the tech sector in the Austin metro alone since the peak. Yet prices haven't corrected meaningfully. Why? Because supply is still constrained, and the expectation of continued population inflow is baked into prices. But here's the risk. If tech layoffs accelerate and younger workers leave Austin for lower cost of living areas, you could see a sharp price reset. In Miami and South Florida, we see an even more extreme case. Miami median home price, $580,000 in 2024, up from $350,000 in 2019. That's 66% appreciation. But here's the complication. Miami has been experiencing population inflow, yes, but the composition has changed. You're getting wealthier international buyers and remote workers, but you're also getting more moderate-income locals being pushed out by rents and home prices. The wage base hasn't kept up. Average wage growth in South Florida is 3.1% annually, but housing cost growth has been 7.9% annually. That's unsustainable. In Denver, it's a similar story. Median price $615,000, up from $375,000 in 2019. But layoffs in aerospace, tech, and energy have been significant. Colorado's unemployment has ticked up faster than the national average. The narrative of Colorado as a booming tech hub is being stress-tested right now. Pattern interrupt. Now let's talk about what happens next. This divergence can't persist indefinitely. Here are the realistic scenarios. Scenario 1. The soft landing actually happens. The Fed cuts rates to 3.75% by late 2025, inflation stays low, and the economy avoids recession. Housing prices stabilize at current levels or appreciate modestly. This requires employment to stabilize immediately, consumer spending to hold up, and no major economic shocks. Probability: 35–40% in my assessment. Scenario 2. Mild recession, contained correction. Unemployment rises to 5%, GDP contracts slightly for a few quarters, and housing prices correct 10–15% in high appreciation markets. Prices in already affordable markets like Des Moines, Kansas City, and Memphis hold steady or decline only slightly. This is the re-rating scenario where prices reset to income multiples that actually make sense. Probability: 40–45%. Scenario 3. Significant economic shock. Geopolitical event, tariff shock that triggers demand collapse, or financial system stress leads to a 20–30% housing correction in major metros and 10–15% nationally. This is what happened in 2008, though likely more contained this time because leverage is lower and lending standards are tighter. Probability: 15–20%. The wild card in all of this is tariffs. Trump's proposed 25% tariffs on Canadian and Mexican goods would directly increase construction costs by 15–20%. Lumber, drywall, concrete, and appliances would all become significantly more expensive. This means two things. First, the replacement cost for existing homes rises, which should support prices. But second, demand for new construction and renovation crashes because it becomes unaffordable. That shifts investment capital away from construction and into existing homes, creating a bidding war for existing inventory. Paradoxically, this might keep existing home prices elevated for longer, but it will brutalize new construction, which we desperately need. Pattern interrupt. So what does this mean for you? If you're thinking about buying, be careful about markets where prices have doubled in 5 years. Look at rent-to-price ratios. In many coastal metros, homes rent for 3–4% of their purchase price annually. That's unsustainable. You're essentially paying $25 for every $1 of annual rental income. Historically, 5–6% rent-to-price ratios are normal. That implies 20–30% downside from current levels in the most expensive markets. If you own a home, you're probably fine long-term, but don't count on major appreciation. The divergence we're seeing now was built on expectations of perpetual rate cuts and continuous population inflow. Both of those are being tested right now. If you're a real estate investor, institutional investors are already rotating out of single-family homes and back into commercial real estate and industrial properties. The window for 10% plus annual returns is closing. The bottom line, housing prices are completely disconnected from economic fundamentals right now. That's not a prediction, that's observable data. The question isn't whether this divergence resolves. It will. The question is how much pain accompanies that resolution.